Welcome to everyone tuning in. Thank you for joining us today. My name is Bryan Shipley. I am the Co-CEO and Co-CIO at Arnerich Massena, a Portland-based investment advisory firm bringing our unique and disciplined process and philosophy to nonprofit endowments and foundations, high net worth individuals, families, and corporate clients. Today I'm here with my colleague, research analyst Ben Larsen, for a look back at 2019 and where we were positioned heading into 2020. We're planning to take a pretty deep dive into some of the market highlights of the year and how the investment landscape looks as we launch into a brand new decade. Ben, thank you for joining us today. It's been an interesting year and I'm looking forward to a lively discussion.
Thanks, Brian. I'm as well. 2019 was a pretty strange year. What do you think overall?
Yeah, as we thought back on the year, we were putting together kind of the market commentary for fourth quarter reports. We kind of looked at one stock in particular, which if you rewound the clock about a year, and you were given kind of perfect information on everything that was going to play out in 2019 and what your expectations would have been for that stock, how would it have behaved, and so the stock that really kind of highlighted the market last year was one that probably everybody knows extremely well, Apple, which makes iPhones and iPads and computers and all sorts of interesting things. But if we'd rewound the clock to January 1st, 2019, and I was to tell you that Apple was actually going to have flat to negative earnings for the year, pretty weak, anemic growth, would you have guessed that stock would have been up 86% for the year, contributing about 10% of the S&P 500's return?
Yeah, no way.
There's no way.
Yeah.
But that was the reality of the situation. But let's not forget that we were coming off of an extremely challenging fourth quarter, so it's always important to kind of know what the starting point was. I'm going to be speaking a little bit out of turn, but I think if you rewound the clock, Apple's price to earnings ratio at the beginning of the year was kind of low double digits, probably 13 to 14%, whereas today it carries a slightly above market premium. But, there was a value opportunity there for people who were willing to look at that opportunity. But just an interesting note of what was happening in 2019. Other things I would point to with Apple specifically, it was a market really dominated by technology, large cap stocks, companies who were aggressively buying back their shares, and we're going to touch on that a little bit later on this podcast as well. But like I said, starting point matters. So Ben, I think it's always important to kind of rewind the clock and look at decades. We want to generally think really long term. And if we rewound the clock 10 years ago or even 20 years ago, just maybe remind the audience of kind of what those prior decades look like.
Yeah, I think it's a really important time as we've kind of wrapped up the last decade to just really reflect over how great of a market the U.S. has been and how great returns have been. And so I think many people like myself, where I started my career in this decade, don't really have a point to reference in terms of the last recession. So all they've seen is just markets going straight up. And so that's really what the last market in the U.S. has been from 2010 to 2019, 13.6% annualized return, which is just insane. Relative to the last decade of 2000 to 2009, it was actually negative annualized return of negative 0.9%. So just a drastic difference between those decades for the U.S. returns. And so if you take a look at emerging markets, where we find some very really attractive opportunities right now on a relative and an absolute basis, the prior decade, from 2000 to 2009, returns were annualized at 9.8% versus this decade was 3.7%. And then you take international equity in the last decade, 2000 to 2009, 2.7% annualized relative to this most recent decade of 5% annualized. So you can see there's some big discrepancies between those returns of really those long-term returns, which we, like Brian alluded to, tend to take a long-term approach. And so these are some of the returns that really our clients are experiencing as we hold our positions for the long term. And I think that's a great leeway, really, Brian, into providing on some of the color onto our capital market assumptions and really our forward-looking returns. As U.S. returns have been great this decade, but what we kind of expect over the next decade, as well as some of the other asset classes like emerging markets and international equities.
Yeah, and that our capital market assumptions is something that we conduct every fall. The analytics team gets together and spends about a month or two really kind of evaluating not only what's happened historically, but what do we expect broad asset classes to provide investors on a go-forward basis, and ultimately that's how we go about building our client portfolios, is with those building blocks. And as you mentioned, it's really important to understand kind of where you came from, because oftentimes markets can, to some extent, borrow from the future. So when you think about fixed income, that has really had a fairly strong decade, but today at very low rates, I don't think investors can look at the last 10 years within fixed income and expect the same kind of results over the next 10 years, just given where we are from an interest rate standpoint. So those are some of the inputs that go into how we go about developing our capital market assumptions. In fact, interest rates is something that really kind of guides every single asset class. It's kind of the first building block of the entire pool. But on a go-forward basis, and certainly this would be reflected in our client portfolios, we would expect U.S. markets, given the success that they've had and the valuations that they're trading at, to perform not quite as well as overseas, and certainly emerging markets like you talked about earlier. Those are markets that are still really growing, and we're going to be talking about some interesting opportunities and dynamics happening within emerging markets, and even more specifically frontier markets, a little bit later in this podcast. But I encourage everybody to check in with their advisors on capital markets. It's actually going to be in your quarterly fourth quarter reports in the market commentary section, so you can see that in much more detail. The other thing that we talked about in the market commentary was just how investment styles have become really, really blurred here recently. Again, I would point to a company like Apple, where it is, I believe, the largest holding in the Russell 1000 Growth Index with a high single-digit weighting within the index. But it is also one of the top holdings in the Standard & Poor's 500 Value Index. So again, that goes back to that dynamic where styles are somewhat blurred. In fact, some of the most extreme, what are viewed as value sectors, thinking of like utilities and REITs and kind of steady Eddie, stable asset classes, trade at pretty high valuations today. And frankly, there's companies within the growth sector that trade at pretty compelling valuations from a valuation standpoint. So, we caution investors to get too hung up on this idea of growth versus value. We think that the lines are really, really blurred. And, frankly, most of the managers that we work with have some kind of valuation component to their research process. In some of our large cap active manager portfolios, you could see names like Microsoft, which was up 50% last year. Again, another one of those leaders from a tech standpoint. But Microsoft has really evolved over the years. At one point in time, it was kind of true value. It was that lost decade that you talked about, where Microsoft really enjoyed that run-up into kind of the tech bubble of the late 90s, and frankly got hurt like a lot of its peers within that sector, and it kind of set the stage for a very kind of dull, from a return standpoint, decade for that company. But they evolved over time, and now they're one of the leaders in cloud computing, and have kind of reinvigorated their growth trajectory. Other names I would point to, Apple at certain points of time, and even Google, you could find, or Alphabet, you could find in some value portfolios.
Yeah, and I think it's really interesting, as many might consider us to be maybe late cycle, as we've been in the U.S. over the longest. We've been in the longest bull market cycle in history. And so typical sectors that perform well late in cycle would be industrials, energy, and materials. And materials and energy, or materials and industrials, have actually performed fairly well over the last year, call it. But energy's really been that sore thumb that hasn't been performing well at all. It's actually been one of the negative returning sectors over the last year and a half relative to the other sectors. So I think that's really interesting, and there could be some structural headwinds to call it oil and gas, where some might have that argument. But I think it's really interesting, as you go into a bear market, some of the sectors that typically perform pretty well are consumer staples, healthcare, utilities, and energy being that fourth one. And 3 out of those 4, call it consumer staples, healthcare, and utilities, look pretty expensive, and have just had a tremendous run, as a lot of investors have really flooded trade out of those cyclical names into those kind of defensive names to take some of the risk off the table, and really a lot of times irrespective of valuations. And so some of our managers that you would consider value, that we would consider value, are having a hard time and really finding value elsewhere out of these typical value sectors because so many people have flooded into these sectors and really made valuations just be, our managers not comfortable with the valuations on the table for these specific sectors.
Yeah, there was a point in time where I think both the utilities and the real estate sectors were actually trading at higher PEs than the tech sector itself. So a lot of that has been driven by kind of this, you can either view it as a flight to quality or just a flight to income, right? With bond markets effectively having a very low coupon and certainly basically a no coupon when you consider inflation, that became kind of the next best step for kind of more income-oriented investors. They would go into those sectors that kick off really attractive dividends, but it got to the point where they were willing to pay for those dividends and really kind of forgetting about the price that they were paying of the companies that spin off of those dividends. And so some from a forward PE standpoint versus a 20-year average, materials are about 31.5% overvalued from a PE standpoint relative to their 20-year history. Utilities at a 38% premium relative to their history. Real estate at an 18% premium. And then you look at the technology sector, and it's only about 11% relative to its history. And when you think from a growth perspective, I know which sector I would want to be leaning into. And again, that kind of goes back to this idea of these growth versus value. You are seeing a lot of value managers with a pretty significant overweight to the technology sector, to the detriment of exactly what you said earlier of those kind of old school traditional value sectors. Why don't we switch gears? Ben, you and I went on a trip to Florida back in December, a couple different reasons. One, we were kind of testing our investment approach and how we go about building portfolios from a kind of U.S. international perspective, and going into that trip with a bit of a mindset on should we be considering a more global approach. And while we're still doing work on that, the other kind of more primary component of that trip was really kind of reevaluating and reaffirming our confidence in frontier markets specifically. So if you could give some kind of highlights from that trip and what we learned would be great.
Yeah, like Brian alluded to, we made the trip out there and had great conversations and really learned exactly what's going on in the frontier market space and kind of the opportunity set out there, and also the catalysts. And so I think that's really the most important, is really those catalysts, as frontier markets have had a little bit of a rough ride, call it, the last couple of years, and it's been really hard to experience a lot of return there relative to the U.S., where a lot of investors are just wanting to flood into the U.S. markets because it's been doing so great. Alluding back to that decade returns of the last decade in the United States is over 13% annualized. And so why would you not be in the United States? You'd kind of look like a fool if you aren't in the United States relative to frontier markets. But we wanted to reaffirm that conviction and really understand kind of some of those catalysts within the frontier market space. And so one, I think, relative to developed markets, frontier markets they're trading at the cheapest valuations in history. And I think that's really important to highlight because as we look at a lot of different sectors in the S&P 500 or in U.S. equities, a lot of them are looking pretty richly priced. So if we want to find some valuations that are looking attractive with some forward returns that could provide some premiums, frontier markets is definitely of interest. So a few other things that we wanted to highlight is really the catalyst for frontier markets that we've kind of deemed viable is the local investors and the pension funds. And why is this important? Because a lot of the pension funds are allocated 4 to 5% to their equities and 95% to fixed income because they're receiving 15 to 20% yields. So why would you take the risk of equities when you can buy government paper and yield 15 to 20%? So there's that structural problem, and I wouldn't say actually structural problem, but more just that temporary issue where central banks have had rates trying to control inflation. So a recent phenomenon that we've been seeing is global central banks cutting rates. And so actually in developing markets, 82% are in expansionary monetary policy. And so as they bring those rates down, pension funds and local investors are willing to take that equity risk because they're no longer getting that 15 to 20% yields on the government paper, but that's actually coming down to call it 5 to 10%. And so then they're willing to take some of that risk within that equity side of their local equities. And so I think that's really important because this space, Brian, it used to be roughly $45 billion in terms of frontier market investments, and now it's dwindled to 8 to 10 billion. Yeah. And so a little bit of capital goes a long way in these markets. And so if we see some of those pension funds move, some of those local investors gain faith in their currency again, this could be a really compelling opportunity over the next few years and really over the next 10 years as we look forward, long term relative to maybe a U.S. or just developed international. I think frontier markets could be a really interesting space.
Yeah, that was probably the most astonishing piece of information I think that came out of that trip was one of the managers, just that flight of capital out of frontier markets. And when you're starting with such a low base to begin with, when you're talking $1 billion or even $10 billion in the U.S., that's nothing, right? That doesn't even barely move the needle for some of the tech behemoths in the U.S. But when you think about these markets that do have some illiquidity to them, and even the locals aren't leaning into them like they have in the past, just any directional movement to the positive coming into these markets will be really, really powerful, and that's frankly a story that we've heard from a number of different frontier markets managers that we've met with here in the last few months. So certainly something to be on the lookout for. I don't think we anticipate any dramatic shift in flows from kind of developed market investors. When developed market investors start seeing returns there, that's when you see kind of that ensuing capital rush, and that's definitely when you want to have some exposure to that area.
And a few other things that we're looking for in terms of tailwinds or catalyst for frontier markets that would really aid some returns and start to see some capital within frontier markets would be, one, a weakening dollar. The dollar's been extremely strong over the last, call it, couple of years. And so if we see the dollar starting to weaken, frontier markets and international equities in general will aid from that. And then also, as we alluded to prior, U.S. markets, investors have flooded into the markets and continue to flood into U.S. equities. And so if we see a deteriorating U.S. market or equities and see a fall off there, we could experience some returns in frontier markets. And so last thing I wanted to touch on in terms of frontier markets is the index. And I think that's really important to highlight because in a market environment where many of our indexes are completely diversified, the S&P 500, the Russells, they're fully diversified. If we look at frontier markets, the MSCI Frontier Markets Index, 31% of the index is made up by 2 companies. So if you don't own those 2 companies, you can imagine that your returns are going to look significantly different than the benchmark. So I think it's really interesting as we evaluate some of our managers and as we look at performance. A lot of times we look at relative performance because you have to. Our managers are basing their performance off a benchmark, and it's not apples to apples because if they don't own those 2 names, they're not in 31% of the index, or they don't even have exposure to 31% of the index. So I think that's really an interesting point to touch on, that the index is very concentrated and it's not a full representation of the asset class or of frontier markets, and that's really what indexes are about. They're supposed to make a broad representation of the market.
And that would be the argument that most of our active managers in that space would make, is a passive approach just doesn't even touch the true opportunity set in those markets. But yeah, you mentioned 2 companies making up such a meaningful amount. Just the banking industry alone, I believe, is over 50% of the index as well. Another thing to think about with frontier markets is you see some activity of countries actually graduating up into emerging markets. So Argentina would be an example of that, a country that actually from a stock market performance standpoint actually performed quite well early in the year And the timing of it was just amazing, where it effectively graduated up into the emerging markets asset class, and then all of the political unrest started occurring within Argentina, where the peso just fell dramatically and the stock market fell dramatically. So that didn't punish the frontier markets index because it had already moved out of it. It did marginally hurt the emerging markets index because it became it was a small piece, but it was a piece of that index. But just another example of things to be aware of when you're investing in these markets, and not to put too much weight in what's happening with the index returns, because frankly we don't feel like that's actually very indicative of the marketplace like it would be in the U.S. with an S&P 500. Impact is an area that continues to be immense focus for our firm, Ben, and you've done a lot of work in that space. If you could provide the audience just a kind of an overview of what we've been up to and what's happening within Impact.
Yeah. So, you've probably heard Impact, ESG. That's been a really kind of a buzzword around the industry, the investment industry, where a lot of people have started to come out with their impact funds or their ESG funds. And so we kind of think of ourselves as approaching it slightly different and taking a thematic approach. So that means we have 4 different themes that we try to approach making an impact or a difference in the world. And that being, one being water, the second being food and agriculture, third being resource efficiency or renewable energy, and the last piece being life sciences and healthcare. And I think it's really important to understand kind of what environment we are currently in, and that being one that we really need to understand kind of the unintended consequences of what we're doing on this earth, really. And so I think that's one of the ways we approach impact investing, and to give you some stats as to why we have this urgency and why we are taking this initiative. As we've been doing this long before my time, 10, 15 years we've been investing in impact. But over these last little bit, it's important to understand that we are in the United States and in the world highest CO2 levels in history. Natural disasters, as you've seen on the media, are increasing rapidly. The annual agriculture productivity growth in the United States is significantly less than 50 to 100 years ago, and we really just need to have urgency approaching these topics. And so that's kind of why we've put our heads together, and we feel like we've really started to make an impact in this space. And again, just touching on our differentiated approach on this, between the end of 2016 to November of 2019, a period of almost 2 years, sustainable assets under management increased by almost $1.3 trillion. So it came from $233 billion to $1.5 trillion. And you can imagine that's a huge amount of inflows, so they call inflows over the last 2 years. But as we dug further into this, we actually found the statistic that 92% of that attributable to sustainable assets can be attributed to rebranding.
Just renaming a fund.
Which is just absurd, because it's just something that they just rebranded and they packaged, and it's a shiny new thing called ESG. And so I think that's really interesting to point that out as we're trying to take a different approach and actually go the step further of not just ESG rebranding, but how do we really make an impact and a difference in the way we invest while not being concessionary with returns.
Right.
And so I think over the last year, we've been able to look at our portfolio, and we've been extremely pleased. And so with the return, but also the volatility characteristics, the risk statistics of the portfolio, and our managers are just making an extraordinarily amount of difference in this world, and being able to report on that as well and showing how they're making a difference. And so I think those things combined really allow us to sit back and say, hey, this is something that is, number one, really important in this world, and number two, I think we're approaching it the right way. Mm-hmm. And so we've done a podcast, a 3-series part, a while back, and if you're interested, you can visit our website and listen to that. And you can learn more about exactly how we approach each theme, the ways we think about that, and how we constructed our portfolio there.
Yeah. It's an interesting space, and I mean, I think we all recognize some of the challenges of kind of this ESG evolution, but the thing that I'm encouraged by is it comes up in nearly every single conversation that we have with any investment manager, and frankly, any prospect that we're talking to today. It's definitely kind of at the forefront of investors' minds. One thing that I'm kind of thrilled about is a lot of our kind of traditional long-only equity managers, which we've done a fantastic job of identifying great managers, actually score extremely well from an ESG standpoint as well. So Morningstar, big provider of mutual fund data, actually has kind of sustainability grades or ESG grades on a lot of the mutual funds that they track. And it's just encouraging to see a lot of kind of our highest conviction managers actually scoring quite well from an ESG standpoint as well. Another thing that we're looking at, and I'm not going to spend too much time on this during the podcast, but I think our research team will be spending some time on it here in 2020, is this idea of kind of the supply-demand imbalance within public markets. We've talked a lot about kind of the shrinking of the public equity universe. And Ben, you're going to remember this really well. 1996, I believe the year you were born.
That was the year I was born.
Basically the year I started my career, so it shows a little bit of an age difference here. But in 1996, there was about 8,000 publicly traded companies in the United States. And that's thinking back to that really kind of tech euphoria where anything.com could quickly get listed on the stock exchange, and investors would be salivating at getting any piece of that IPO and driving stock prices higher. And that's what drove a lot of the euphoria during that period, and frankly, a lot of the disaster that happened in the ensuing years for indexes like the NASDAQ, which closely follow the tech industry. Today, in 2019, that's been cut in half. And we've talked a lot about that. But the other point of this that I don't think we appreciate quite as much is not only how that number has been halved, but just how aggressively a lot of companies have been buying back their own stock. And it makes sense to some extent, where if you can borrow debt really cheaply or effectively for free for some of these large organizations, why wouldn't you take on debt and buy back your shares if you thought that they were undervalued?
Yeah.
And so I'm gonna pull Apple again out of the bag, but I don't think a lot of people recognize this. But the number of outstanding shares that are publicly traded for Apple has declined by about 30% over the last 5 years or so. So not only do we have the shrinking number of absolute companies, but the availability of their shares and the number that are floated out into the public market is shrinking as well. And yet we have this tide of 401k money entering the market every 2 weeks that frankly is just buying the market at any price. And so that's something that we as an analytics group are going to be diving into a little bit more, and we just want to have a full appreciation of what's happening there and making sure that we're capturing that opportunity really, really well. Any other comments on that? Stock buybacks, indexation. I guess the other thing I would point to is, along with the impact story, is we've recently started working with a group where we're able to craft client portfolios specifically for what they're looking to do, whether it's ESG or eliminating certain fossil exposure.
Mm-hmm.
The world of indexation is changing and changing quickly, whether it's ETFs, direct indexing, which is the group that I'm talking about that we're really excited to be working with going forward. Just a lot's changing in that space, and that'll be an area that we're going to continue to look in, both pros and cons of indexation.
Yeah.
So I think there's things to be looking at on both sides.
Yeah, absolutely.
International markets has continued to be kind of an area of importance in our client portfolio construction. And again, I would point to our capital markets assumptions as some of the rationale for why we believe it makes sense to have a meaningful weight in your portfolios to those markets. We do believe that they are going to outperform over the next 10 years. Emerging markets, we have modeled a return of about 9.4% for the next 10 years. Developed markets at about 7.3%, and then U.S. large cap at 5.7%. So pretty meaningful premiums to international developed, but certainly emerging markets for sure. And then we expect U.S. mid-cap and U.S. small-cap to have slight premiums relative to the U.S.
And just one other thing to touch on as well is, it's important to really have a fully diversified portfolio because although emerging markets is projected by in our capital market assumptions to have a premium. It's also projected to have a higher standard deviation. So it's important to really understand the risks that you're taking in your portfolio, but also to have that exposure in your portfolio. I think you'd really be missing out if you didn't have some emerging markets and some international equity in the portfolio.
Yeah. There's a lot we can cover, but we want to be sensitive to the audience's time, and perhaps we'll do kind of a part 2 of this for some other areas that we think are important to touch on, whether it's fixed income. We talked about kind of an inverted yield curve in 2019, what's happening with the Federal Reserve. There's just so much to talk about that it'll make sense either for your advisor to communicate things that we're thinking about as an organization, or perhaps members of the analytics team can regroup and do another podcast. But we want to thank you for joining us today. For more information and discussion on investment topics, please visit our website at www.arnerichmassena.com. You can check out our previous podcasts covering investment trends to watch for in 2020. You can read our blog or take a look at our research section. This has been Bryan Shipley and Ben Larsen. Thank you, Ben.
Thank you
for joining us today, and thank you to all for listening. Have a great 2020.
Thank you for listening to Arnerich Massena's podcast. Please see the podcast description for important copyright and disclaimer information.